Hello learner, welcome to Manifested e-learning platform. My name is F.A.M. Ngwiri and I practice within the financial services industry in Kenya. Ladies and gentlemen, today we are discussing about business and data analytics, which is an exit paper under the CPA qualification. We are doing section 2, question 21. And as you can see on your screen, the question reads as follows. You are provided with the following extracts of the statement of profit and loss for Sepetuka Limited. So you can see you've been given the statement of profit and loss from the years 2019 through to 2022. The sales are provided, cost of sales, the gross profit is also given, operating expenses, operating profit, depreciation, profit before interest and tax, finance costs, profit before tax, income tax expense, and profit after tax. You are required, A, to calculate and interpret the following ratios. Number 1, annual revenue growth rates for years 2020, 2021, and 2022. So what I'll do, I will just copy this extract over here onto the right of your screen, copy, and what you've learned in terms of the shortcuts, Control V, you can be able to see it's actually come easily there. What I need to do is that I need to differentiate between the question and the answer in terms of color. So I come to home and I just press blue there, it changes the color immediately. So in trying to answer part 1, which I can be able just to do right down over here. So part 1, that, then I put it in brackets over here. Because we're beginning from 2020 through to 2022, I will just indicate over here 2020, 2021, and 2022. So then you don't even need to write anything. So if you've got, like, say 10 years, you just drag this, it tends to pick. But if it doesn't pick, you click this autofill options icon there. You're supposed to fill the series. You just fill the series and it comes like that. So the reason for that is because you could be able to have at least a 10-year period that you want to generate the years. So you don't have to just keep on writing or typing on your keyboard there. You just drag and you come to autofill options over here, then you fill in the series there. So here, the formula, I'll just write it just beside over here of how to compute part 1. The annual revenue growth rates, you pick the value at the end minus the value at the beginning, then you divide by the value at the beginning. So you come to insert, you can see right over here, insert, and I want to insert an equation so that we can be able to move forward ahead. What do I want to insert? A fraction that looks like that. So this is what I get, and I can just drag this towards the right of the screen if it allow me. You can see it right here. And I put what I've just said there. So I'm talking about the wealth at the end of the period. Then I subtract the wealth at the beginning of the period, like that. And then I divide that against the wealth at the beginning. So wealth at the beginning. In form of a shortcut, we can be able to just write down over here or what? Or which other formula, which is usually shorter. So I center that. We come over here, ladies and gentlemen. So I just try and differentiate that by inserting like that. Or I can say wealth at the end divided by wealth at the beginning minus 1. It will still give you the same result. So I insert again a fraction or an equation. Then I come here fraction because I'm inserting like that. You could either select either of the options which will provide you, so long as you have a fraction. So you can just pick here that the wealth at the end, you divide that against the wealth at the beginning, and then you press the right arrow minus 1, and you can be able to see it's over there. So I didn't press the minus, so the minus 1 there, like that. So just to enlarge it, over here you can just see it clearly over here. Once I try and enlargen it like that, it should be able to give you the same result there. So once you increase the font to, say, for example, maybe say 12 or 13 like that, you can be able to now clearly see what I'm talking about over here. But I remove this minus sign to ensure that it's correct there. So for simplicity's sake, we'll apply this second formula over here onto the 2020 period. So you pick the value at the end, and we're talking about what? We're talking about revenue. So sales is the same as revenue. So we pick plus. In Excel, you must put plus the value at the end, or the wealth at the end. Then we divide that against the wealth at the beginning like that, and then we minus 1 like that. So you will continue. Now, how long will you continue? You've got, say, 10 years to continue. Will you be able to do that continuously for 10-year period? No. We're saying we apply the same concept we've already just learned over here. So I just drag the formula like that, and it will actually pick for the annual revenue growth rates. But revenue growth rates should be expressed in percentage form. So where do we go? We come right over here under number. But if you prefer using the keyboard, we can be able to press Alt, and then we can be able to see, because we have to talk about home. So H, and what do we want? You can see here, right here clearly, we press P, it should give us percentage. P refers to percentage like that. So we just click P, and you can be able to automatically see, ladies and gentlemen, it actually gives you a percentage there. So before we move to part 2, I can say part 1 was asking about what? Annual revenue growth rate. So I can just write here annual revenue growth rates. Like that. So it may be overlapping, no problem. We just come over here and double click. You can see that plus sign over there, that plus that's there. Just double click, and it actually opens it up like that. Part 2 over here is asking us the 3 years cumulative average growth rate, CAGR. The industry convention usually refer it to CAGR. So when we compute the CAGR for 2022, it means that we need to pick this value here, allow me to highlight it in a color there, and this value right over here. So we'll apply the same concept that we have discussed right over here. You can see it still on your screen over here. However, we'll apply it based on the 3-year CAGR rate. How do we do that? So I can say 3-year cumulative average growth rate, year CAGR, allow me to use CAGR, like that. And it will only appear, ladies and gentlemen, right here, because we're not looking at the average, the CAGR rate for 2020, 2021, 2022. We're looking for that period up to there. So what we can be able to do, we just pick plus the value at the end of that 3-year period. Then we divide that. We are applying this similar formula, a similar formula to that over here. We divide by the beginning value. We need to insert it in brackets so that we can be able to ensure that the formula is complete. Then we raise it to how many years? Power. So power is, you press Shift and 6. You can see 6 on your keyboard. It shows above 6, there's a kind of like a power there. That represents power. So power, we open the brackets, power 1/3 or a third, like that. And then we minus 1, or we subtract 1. So we subtract 1 over there, and we see what the CAGR is for the 3-year period. Press enter. It gives you 20.96, but we want it in form of a percentage. Remember what we said? Alt, we press H. You can see what H gives us, home, H, and then now we want percentage, P. You can see we press P, represents the percentage, so we press P. Automatically gives us 21% like that. If you want it maybe in 2 decimal places, we still come over here. Now I'm not going to use the keyboard or the shortcuts. We're going to come over here and increase it using increased decimal like that. So we just increase it like that and like that. So 20.96, 21% is okay. We move on to part 3 of the question over here. So that's you can just drag it down over there. Then you just add one of the you can just add I onto it, so it can be able to represent part 3. Part 3 is asking us to compute the effective tax rate for the period 2019 to 2022. How do we get the effective tax rate? Now in this case over here, what I can be able to do, because they're asking us for 2019, I'll be able to just perhaps maybe just I'll include it over here because it's asking us from this year here. So allow me to use the effective tax rate, or I can be able to just insert here, insert a column like that, and then what I can do, I drag this back towards this other side over here, and there's no problem with dragging on that. So you just drag it like that, it will just pick like that, or you can copy, whichever you prefer, right there. So once we have that, so we double click on that, it will open up like that. So we want the effective tax rate. That. The effective tax rate, we will pick income tax expense, we divide it by the profit before tax. But now we can see that the income tax expense is a negative value, so we need to adjust for that. So how do we do it? So just pick plus in Excel, we pick the income tax expense, but before we put the plus, because we'll get, if you see what we'll do, I'll pick the income tax expense and then we divide against the profit before tax like that. It will give us a negative answer, negative 0.3. There is no tax rate that is negative. So what do? I just clear that, we pick plus, and then we put a minus sign there, plus minus, you can see. So I've picked that value and I divide that against the 5200 like that, gives us that. But we want it in percentage form. So we highlight, we first of all drag the formula for it to pick until you see that plus sign, ladies and gentlemen, not this plus sign, you drag it to the bottom right hand corner, bottom right hand, until you find that plus sign, you drag it like that, and you should be able to get the tax rate like that. Remember what we did? Alt H, then we press P for percentage. P gives us 30% like that. So once we have dragged the formula, you can see the effective tax rate is 30% all through from 2019 to 2022. This answers the third part of the question, which was asking us to compute the effective tax rate for that period 2019 to 2022. Before we conclude, let's just recap what we've just discussed. In part 1, they wanted us to compute the annual revenue growth rates for years 2020, 2021, 2022. And you can see we had already computed them right over here. How we compute the annual revenue growth rates, we have the formula on the right of our screen here. Value at the end minus value at the beginning divided by value at the beginning. Or short form, wealth at the end divided by wealth at the beginning minus 1. For the cumulative annual growth rate, which is also called CAGR, industry convention, we compute the 3-year CAGR as follows. We first of all get the wealth at the end. We divide that against the value at the beginning of the 3-year period. Why we're saying it's 3 years, it's because from here to here is 1 period, from here to here is 1 period, and from here to here is 1 period. So that represents 3 years. So we get the value at the end, we divide that against with the value of at the beginning, we raise that to power 1/3. Why 1/3? Because we're talking about the 3-year period, or the 3-year growth period, 2019 to 2020, 1 period, and another period there. So it's raised to power 1/3. And then you subtract 1 to be able to give us the compound annual growth rate. And you can be able to see the formula once I've clicked over here on this part, the formula bar. I double click it, it will highlight those values that I've picked. Value at the end divided by value at the beginning. Then you raise it to power 1/3 for the 3-year period minus 1 there. For the tax rate from 2019 through to 2022, we just picked, because we have seen the tax rate is negative over here, we cannot be able to have a negative tax rate. We picked just the income tax expense here. We divided that against the profit before tax, and we got that value there. So to double click, you can see I've picked that value, L19, which is this one here, divided by L18, like that. And then, of course, to convert it to percentage, you just click this button over here like that, and you drag the formula as you move towards the right. This brings us to the end of part A, question 21, which came in December 2022 Business and Data Analytics paper. Thank you for being with us. God bless you.
Welcome learners to our today's session. My name is Celestine Wandabusi, and we are continuing with the revision management accounting December sitting. Today we'll be proceeding to question number 4 of the previous lesson. So question number 4, part A, we are told that outline 6 benefits that might accrue an organization as a result of preparing budgets. So then 6 benefits for budget preparation, or which might accrue an organization as a result of preparing budgets. So number 1, I'll give a summary, then I'll explain. Number 1 is planning. We have a benefit, it is assisting in planning. 2, it will assist in controlling. Number 3, in coordination of activities. Number 4, can motivate, so we have motivation. Number 5, clarity of responsibility and authority. And then number 6, we have planning, we have controlling, we have communication as number 6, communication tool. So 6 benefits for budget preparation. What are the benefits? When we prepare budgets, we do a financial or a monetary plan. And whenever we do a plan, it means that when we are spending or whatever activity we undertake according to that plan. And when we are doing that, it will help an organization, especially in allocation of scarce resources. Where there are no resources, an organization will be able to know where to allocate, when to allocate, so that is able to minimize costs to do with financing costs. And that is the work of planning. Like when we are preparing a cash budget, we normally look at what are the expected receipts, or what are the receipts and what are the payments. So when the payments exceeds the receipts, it means that we'll end up having a deficit budget. So when we have planned and we have a deficit budget, it will prepare an organization to know where it can be able to get funds to finance those activities or those expenditures that are yet to be financed. And then controlling is simply where we are looking at the actual results and that which was budgeted, so that we see whether there are any variances or discrepancies that will help an organization or the management to know the necessary actions to be undertaken. So through budgeting, we can be able to do the controlling function. How? We will look at our budget. What was that was budgeted? And what is the actual result? So when we have that which was budgeted and the actual result, we will be able to know the variances or the differences between that which was budgeted and that which is the actual. Like you had budgeted to spend 100,000, you have now spent 150,000. What is the difference? That is 50,000. Why 50,000? Is it favorable to an organization or not? And if it's not favorable, then which action should the firm undertake to ensure that that is not repeated again? That is, it is assisting in controlling function. And then coordination of activities. Through budgeting, all the activities of an organization can be coordinated. How? When we are preparing budgets, we do involve all the departments in an organization. And when we are involving all the budgets, we normally have budgets depending on others before they can be worked out. Like when we are preparing for Department A, sometimes when Department B is budgeting, sometimes it has to base on the activities of Department A before it finalizes on its activities. And through that, we will have coordination of activities relating one department to the other. Motivation, how can budgeting result to motivation of employees? When a budget is formulated, there are some targets that are normally set. When those targets are tight, they motivate the managers to work towards achieving them. And so, like when we have a plan of producing 100,000 units, the the manager who is responsible for the production department will have to ensure that he is able to produce 100,000 units. And so how does he do that? He is motivated to produce 100,000 because it is laid down in that budget for it to be met. And because of that, he will work towards achieving the 100,000 units, and that's what we are referring to as motivation. So where there are no budgets, managers will work the way they want. But if we have budgeting, it is motivating them because of the targets that have been set. Then number 5, clarity of responsibility and authority. In budgeting, we consider the high-level management involving themselves in budgeting. Though we have the mid-level managers and the lower level, but now when it comes to lower-level managers, they associate themselves with the workers who are the subordinates. So to get all the information concerning what needs to be done, we have these supervisors or the lower-level managers who associate or relate with the subordinates so that they are able to report to the immediate supervisors who then will report to the highest level. And when such happens, we are able to clarify, or the organization can be able to clarify who is to do ABC, like during the budgeting process, and who should you report to. In other words, who is your senior. That is normally done during, like when we talk of the budget committee is outlining the management and the responsibilities of all those that are involved in the budgetary process. Number 6, communication tool. A budget can act as a communication tool, and therefore it has a benefit of acting as a communication tool. During the budgeting process, this budgeting process is involving communication. We have liaison of one department with the other, and that's done through communication. We have both vertical and horizontal communication, and therefore we say that a budget itself is communicating what needs to be done, and during the budgeting process, again, there is communication that is involved. And therefore, through budgeting, we can have a benefit of a budget being used as a communication tool. That was part A of question number 4. Then we move on to part B. We are told that you are in charge of making forecasts and preparing budgets for Condé Limited. You have been supplied with the following cost and revenue forecast and details of payment. So we have been given a forecast for revenue and cost for half year of 2022. So the details are beginning from January to June of the year 2022, and then we have additional information. Note number 1, cash balance, that is on 1st April 2022, is expected to be 90 million shillings. Note number 2, period of credit allowed by suppliers averages 2 months. Note number 3, debentures worth 125 million are expected to be issued in May 2022, and the amount will be received in the same month. Number 4, a new machine will be installed in March 2022 at a cost of 150 million, and payment is expected in the month of May 2022. Note number 5, sales commission of 3% is payable after 1 month of sale. And then note number 6, a dividend of 100 million is to be paid in June 2022. Note 7, there is a delay of 1 month in payment of overheads and wages. Note number 8, 20% of debtors pay cash, receiving a cash discount of 4%, and 70% of debtors pay within 1 month and receive 2.5% discount, while the remaining debtors pay within 2 months without a discount. Then required, a cash budget on a monthly basis for the months of April 2022 to June 2022. So when we prepare a cash budget, you need to understand what a cash budget is. So a cash budget is simply that budget that is recording the expected cash receipts and the expected cash payment. So we do not include any credit transaction on a cash budget. Where we have credit transactions, then the interest is when should this cash be received, or when should this cash be paid. So in the period when cash is received is when we record that on the cash budget, or a payment made is when we record on the cash budget. So we'll prepare the cash budget. So we have that format for preparation of a cash budget. So we are concerned with the month of April, May, and June. These are the periods for the budget, and so we will have details under that. So we'll begin to interpret the additional information. We are told that cash balance on 1st April 2022 is expected to be 90 million. So cash balance is simply that balance that is to be brought forward. So what we do, we bring it forward. This is cash balance that is brought forward. And it will be brought forward, we are told, cash balance on 1st April, which is expected to be, so that we'll record 90,000 instead of 90 million. So that is note number 1. Cash balance on 1st April is expected to be 90 million. So this is our cash that is to be brought forward. Then note number 2, we are told that period of credit allowed by suppliers averages 2 months. So remember, suppliers are those people who are giving this organization goods on credit. So that means they are the creditors to the firm. So they are allowing a period of 2 months. 2 months means, for example, if we have direct material purchases, we were given from January to June, and we are interested in preparing the budget for the month of April, May, and June. So when is this payment to be made. Giving an example, meaning when we have direct material purchases for the month of February, 2 months credit means those that were taken on credit in February are to be paid in April. So when we are preparing the cash budget, we will indicate that. Note number 3, we are told that debentures worth 125 million are expected to be issued in May. So our interest is when are they issued, not when they are issued, but when is the receipt of that payment. So the amount is to be received in the same month. So we'll record that. And then a new machine will be installed in March 2022 at a cost of 150 million, and payment is expected in May 2022. So we'll simply record that amount based on that month, and then we will show the workings. Our number 1 working is note number 5, sales commission. Sales commission. We are told that sales commission of 3% is payable after 1 month. So that means if we are to calculate for the month of, so we want to calculate for the month of April, May, and June. So how will we calculate that? To calculate the sales commission for the month of April, we are looking at the sales for the month of March. What were the sales of the month of March? The commission for March is to be paid in April. And so for the cash budget, we will make payment in the month of April. So for April, we are taking 3% times the March sales, which were 440,000. For May, we will take the sales for April, which is now 3% of the sales of April, 350,000. What will we get? Then for June, we get the sales of May. That's 3% multiplied by 360,000. Then that will be the commission. So 3% of 440,000. This is 13,200. Then this will be 10,500. This is 10,800. So those are the amounts we'll use in the cash budget. We move on to note number 6. We are told that a dividend of 100 million is to be paid in June. So we will pay that in June. Note number 7, there is a delay of 1 month in the payment of overheads. Delay means there will be a lag in payment. So the payment that was to be done in the month of March will be done in the month of April. That were to be made in the month of April will be in May, and so on. So there is a delay of 1 month in the payment of overheads. We've been given the overheads. So we have note number 2, overheads. So the overheads here are including production. So what will we pay in April for production? In April, April, we have May, and we have June. So for production overheads, those that were to be made in March will be made in April. So in March we had 40,000, which is now to be made in April. So we simply write 40,000. For May, those that were to be made in April are the ones that will be made in May, which is 45,000. And then in June, those that were to be made in May are the ones that will be made in June, and that is 36,000. And then we also have administrative overheads. We have another 1 month lag. So those that were to be paid in March are to be made in April. So we have 27,000. And then for April of 24,000 will be made in May. And for May, 25,000 is to be paid in June. We also have selling and distribution. Selling and distribution, we also have 1 month lag. Those that were to be paid in March will be paid in April, that's 18,000. That which was to be paid in April will now be paid in May, that's 13,000. And that which was to be paid in May will be paid in June, which is 11,000. We were also told, and wages. We also have a delay of 1 month for paying wages. So the wages that were to be paid in March will now be paid in April. Those that were to be paid in April will be paid in May. Those that were to be paid in May will be paid in June. That's note number 7. Then the last note, number 8, we are told that 20% of debtors. So we calculate debtors, cash collections. So we have cash received. We are still using the month of April, May, and June. So what were the cash collections? We are told that 20% of the debtors pay cash. So we are to get 20% of the debtors in the month of April. So if we want to know how much was received in April, because it is received in cash, we calculate in April. So we have 20% for April times 350,000. 350,000. That will give us for April 20% of 350. That's 70,000. So for May, you are also getting 20% of May, which is now. So that is for April. The cash that was to be received in the month of April was 70,000. But on the same note, number 8, we are told that a cash discount of 4% was given. So when a cash discount is given, it is allowing or prompting the customers to pay promptly. And when they pay promptly, they pay less than what they should have paid if they were to pay at the end of the credit period. So that means when the firm is allowing that discount, it will receive less cash than what it will have received. And therefore, we are to subtract a discount. We have discount, we less discount at 4%. And discount at 4% simply means it will be 4% of 70,000. They were to pay 70,000, but because they are given a discount of 4%, they will not pay all the amount. And so what the firm receives is less than what they would have received. So 4% of 70,000 will be 2,800. So we subtract that, and whatever we get will be the cash received. So this is 67,200. So what we'll put to the cash budget will now be 67,200 and not 70. Why? Because there was a discount that was given to the debtors. We do the same for the month of May. So for the month of May, we are to calculate 20% of the May sales. 20% of the May sales. So the May sales were 360. 360, sorry. May sales were 360,000. So when you calculate that, this will give us 72,000, and then we are to less 4% of 72,000, which is 2,880. So we subtract this, and this will give us 69,120. This is the cash that is received. Then for the month of June, we also have 20% of the June sales, which were 360,000. So this will give us 72,000, and then we less 4% discount of the cash that was to be paid at the end of the credit period, which will be 2,880. So when you subtract this, we'll get 69,120. This will also be the cash to be received. Then on the same note, number 8, we are told that and 70% of debtors pay within 1 month. Paying within 1 month means when they buy in the month of April, before the end of April, they will have paid. So that means that amount is again to be recorded in that very month. So to calculate that, we also have now the cash collection at 70%. For the month of April, the sales were 350. So we get 70% of 350,000. And this will give us 245,000. We less a discount of 2.5% on 245,000. This will be so we less 6,125. Which will give us 238,875. Do the same for the month of May. Get 70% of the May sales, which were 360,000. This is 252,000. and then we less a discount of 2% on that which was to be paid. And this will give us 6,300. So when you subtract the cash, this is the cash collection. The cash collection will be equal to 245,700. And then for June, so the June sales equaled the May sales. So we have 360,000, which will give us 252,000. Then we less 2.5% of 252,000, which will give us 6,300. So when we subtract, we'll get 245,700. And then lastly, we are told in the same note number 8, we are told that while the remaining, so remember we had 20% of the debtors, we have 70%. So it means we still have a balance of 10%. So the remaining 10% pay within 2 months without a discount. So without a discount means we will calculate on the sales, and the 10% is what will be paid, but after 2 months. So since we were given sales from the month of January, it means that those that were to be paid in February will be based on the sales that were made in, those that will be paid in April will be based on the sales that were made in February. So cash collection at 10%. Cash collection at 10. This was at 70%. So the cash collection at this for the month of April will be equal to 10% of February sales. 10% of February sales, which is 350,000. So this will simply give us 35,000. Then May, it will be paid in 2 months. So meaning those that were given out in March are the ones to be received in May. So March sales, we get 10% of 440,000. And this will give us 44,000. Then June, those that are to be paid in June will now be calculated on the April sales. So we get 10% of 350,000. And again, this will give us 35,000. So once we make those adjustments, we now come to our budget and simply put in the figures. So once we have the cash balance that is brought down, we are to identify the receipts. We add receipts. So what are the receipts in the question? The receipts, we have the cash received. So we have cash from sales. For the month of April, what was the cash? We have 67,200. For the month of May, the cash received was 69,120. And for the month of June, we had 69,120. Then we have cash collection. Cash collections from debtors. So the cash collection from debtors for the month of April we are taking this cash collection at 70% and the other cash collection of 35 or at 10%. So we have 238,875 plus at 10% 35,000, and this will give us 273,875. We do the same for the month of May. For May, the cash collection at 70% was 245,700, and at 10% for the month of May was plus 44,000. So this will give us 289,700. Then for the month of June, this was 245,700 plus 35,000. And this will give us 280,700. That is the cash receipts and collection from debtors. We also look into the question to find whether there were any cash receipts. In note number 3, we are told that debtors worth 125 million are expected to be issued in May 2022, and the amount will be received in the same month. So these debentures will be issued in May. So we have debentures. The cash received will be in May, and the amount is 125 million. So you simply record in that period. There is no other cash receipt. So we underline this. So after showing the cash, we will calculate total cash received, which is simply the addition of this. So we show payments. So before I add, we'll show the payments. In the question, we had payments, we have commission. Commission was a payment. That is not number 1. So this is working number 1. This was overheads was number 2. Debtors was number 3. That's cash received number 3. Cash collections number 4. So cash from sales, this was working number 3. Cash collections, this is working number 4. And then commission, we have commission as part of payment. Sales commission. Sales commission. So sales commission for the month of, this is working number 2. Working number 1, not 2. For the month of April, we had 13,200. May, 10,500. And for the month of June, we have 10,800. Then the next cash payment is note number 2. That's overheads. So we have production overheads. This is working number 2. Production overheads, April was 40,000. May, 45,000. And June, 36,000. The next is administrative overheads. Still working number 2. For April was 18,000. May 13,000, and June, no. For April, administration should be 27,000, 27,000. For May, we have 24,000, and for June we have 25,000. We move on to selling, distribution. Selling and distribution. Still working number 2. For the month of April, we have 18,000. May, we have 13,000. And June, we have 11,000. We also have wages. Still working number 2, wages. For April, we have 100,000. May, 72,000. And June, 54,000. So that was not number 7, not number 5. We were told that, sorry, not number 5, not number 4, a new machine will be installed in March. So we have installation of new machine. We are told that a new machine will be installed in March 2022 at a cost of 150 million, and payment is expected in May. So we make payment in May, and that is 150 million. Note number 6, a dividend of 100 million. So we have dividend. Dividend of 100 million is to be paid in the month of June. So we will pay a dividend of 100 in the month of June. We were also told in note number 2 that period of credit allowed by suppliers averages 2 months. So the period of credit is applying to direct material purchases. When you look at direct material purchases, we were given from the month of January to June. So we are told that the period of credit allowed by suppliers averages 2 months. So we need to make credit purchases. Credit purchases. So the credit purchases are on direct materials. And so if given 2 months period, it means that that which was given in the month of February is what will be paid in the month of April. So for us to record the payment, we are recording the payment for the goods that were given in the month of February. So for April, we record that for the month of February. And for May, we record for the month of March, which is 135,000. And for June, we record for the month of April, which in that case is 90,000. So that's how we make payment. So for the month of April, we allowed the month of April and the month of March, so that the payment is made in the month of April. Then for those that were given in March, we are allowing 2 months credit so that it is paid in May and so on. So from there, we simply make the calculations. And when we are calculating, we begin with the first period, which in this case is April. So we'll get the receipts. So the total receipt is 431,075. We also show the total cash payments. So we will have total cash payment, and then cash balance that is to be carried down. So we do the cash payments for the month of April. So this is a 298, sorry, first. So this is 298, 200. So the cash balance is cash received minus cash payment. Which will give us 132,875. We do the same for the month of May. So this balance is now to be brought forward. This is 132,875. We bring it in the next period. So this will give us 616,695. This will be 449,500. So we get the cash balance to be carried forward, which will be 167,195. And then we bring it in the next period, 167,195. So the total cash here is 517,015. So this will be 326,800. Then we get the balance to be carried forward. And this will be 190,215. So when we get a positive balance, that simply means it is a surplus. A surplus means the firm had more receipts or is expecting to receive more than what it will spend, and therefore there will be a surplus remaining, which can be used for other purposes of the firm. And that was all about question number 4. So you can read more on budgets and budget preparation. We have fixed and flexible budgets. You can look at other budgets, functional budgets like sales, production, labor, and fixed overhead, etc. And that brings us to the end of our session today. Bye-bye. Let's meet in the next session.
Hi candidates, welcome to another session of Manifested Online Classes. So in this session, I want us to continue with the subtopic of impairment of non-cash generating assets. And in this particular session specifically, I want us to look on some illustration questions regarding how to determine the impairment loss of non-cash generating asset under the 3 approaches we have discussed in our previous session. That is the depreciated replacement cost approach, restoration cost approach, and what we refer as the service unit approach. So let's read or go through the particular illustration. We see what we are told, and it reads, on 1st January 2009, the government built a market at a cost of 150 million The market was expected to provide services for 40 years. On 31st of December 2018, after 10 years of use, a fire caused a severe structural damage to the market. Due to safety concern, the market was closed down for repair that would cost 106.5 million. These repairs were made to restore the market to occupiable condition. The current cost of a new market is shillings 300 million. So what are we required is to determine the impairment loss to be recognized for the market using the cost restoration approach. So what we are required to do there is we determine the impairment loss using a restoration cost approach. So the first thing which you need to remember here as a student is how do we determine the impairment loss of a non-cash generating asset under IPSAS 21. So the impairment loss is equal to the carrying amount of a non-cash generating asset, which is the same with the net book value minus the recoverable service amount. So therefore, what we need to do for us to be able to determine this particular impairment loss, we have to determine these two values, the carrying amount and also the recoverable service amount. So let's determine we start by determining the carrying amount. Which is the same with the net book value. And we are determining this on which date? On 31st of December 2018, because what we said in our previous session is that impairment review is undertaken whenever there is a factor or indicator showing that the asset could be impaired. And actually what we are told is that on 31st of December 2018, this market, which was constructed by the government, which is a non-cash generating asset, was damaged by fire. So that is a factor which indicates that this market, which is a non-cash generating asset, could be impaired, and therefore the impairment review must be carried out on that date. So we need to have the two values on that date. So the net book value or the carrying amount, this one is equal to the cost, and we are given the cost of the market, which is 150 million. So we less the accumulated depreciation. So the accumulated depreciation in this case will be computed by taking 150 million. And then in sentence number 2, we are told that this particular market, which was constructed by the government, it was expected to provide services for the next 40 years. So anytime you're given the expected useful life of an asset, you then determine its depreciation using the straight line method. You take the cost divided by the estimated or the expected useful life of that particular asset, and then this will give us now the depreciation per annum. So what we need to do is to determine, we are determining depreciation for how many years. So from 2009, when the market was constructed or was built, up to 31st of December 2018. So how many years do we have there? So we have 2009, 2010, 2011, 2012, 2013, 2014, 2015, 2016, 2017, 2018. So these are how many years? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So we have 10 years. So meaning that our interest is to compute or to determine the accumulated depreciation for how many years? For 10 years. So this is the cost, which is 150 million. So let's compute this particular accumulated depreciation, which will be equal to 150 divided by 40 years times 10, which will give us 37.5 million. We less that from the cost, and whatever you get here is the carrying amount or the net book value. So we less that from 150 million, which will give us 112.5 million. So having that, then we proceed and we determine the recoverable service amount So we have to recall what we said in our previous session, that the recoverable service amount, this is the higher of two values, higher over two values. Number one, the fair value less cost to sell, which is also known as the net realizable value, net realizable, or we can just abbreviate it as, we can just put it as NRV, net realizable value, or Roman 2, what we refer as the value in what? In use, the value in use. Now, if you check on the information which are given in this particular question here, you'll be able to see that the examiner has not given us what we refer as the fair value less cost to sell, because the fair value less cost to sell, this is the amount at which now the asset can be sold at currently, minus any cost which will be incurred in selling that particular what? Asset. And as per the information which you are given, this figure is not provided. So this figure is not provided. So therefore, this will not apply in our case. We are not going to consider that figure there. What we need to do is we proceed and we determine the value in use. Now, remember in our previous session, we said we have three methods, three approaches which can be used to determine the value in use. But in this particular question, the examiner is requiring us to do that using a method which is known as what? The restoration cost approach. So therefore, we are determining the value in use using the restoration cost approach. Restoration cost approach. So how do we determine the value in use under the restoration cost approach? So first of all, we take the replacement cost, which is basically the cost which will be incurred currently in terms of replacing that asset which is damaged. And I think in the last sentence of this particular question, we are told the current cost of a new market is 300 million. So if the government want to construct a similar market currently, that will cost the government 300 million, meaning that this is the replacement cost. Then what we do, we depreciate this replacement cost for this equivalent duration. So what that means is that to this replacement cost, we less accumulated depreciation, which will be equal to the replacement cost. And then we are saying we depreciate 300 million for an equivalent duration. So meaning we divide that with 40, just like what you have done here, times what? Times 10. So this will give us now an amount of how much? So we have 300 million divided by 40 times 10. So which will give us 75 million. We less it from that figure, which will give us 225 million. So whatever you have here, we refer to this as depreciated replacement cost. Now, after getting that under this particular approach here, we proceed and we less the restoration cost. So remember, we said the restoration cost in our previous session is the cost which will be incurred in terms of restoring an asset to its pre-impaired state. So essentially, we said that this is equivalent to the repair cost. How much repair costs will be incurred by this particular public sector entity in terms of repairing an asset which is now deemed to be impaired? And I think if we go back to the question which you are given, to the information which you are given, we are told due to the safety concern, this market was closed down for a repair to be done, and we are told that repair will cost, or basically the repair cost is 106.5 million. So that is now the restoration cost. So we less it from our figure up there. So we have 225 minus 106.5. So which will give us 118.5 million. 0.5 million. Yes. So this is now what? This is the value in use. The value in use. So having the value in use, next what we need to do is to determine now the recoverable service amount. The recoverable service amount, of which you are saying the recoverable service amount should be the higher of these two values. Should be the higher of what? Of the fair value less cost to sell, this one, and the value in use. And take into account we don't have this value, it is obvious that our recoverable service amount will be equal to the value in use. So therefore the recoverable service amount is 118.5 million. 0.5 million. So having that value, what we need to do is to determine whether this asset is impaired or not. Remember we said that an asset is said to be impaired whereby the recoverable service amount of such an asset is less than the carrying amount. So in our case, we already have these two values. So we have the recoverable service amount, which is a figure of 118.5 million. What about the carrying amount? The carrying amount is what we have here. That is 112.5 million. So we need to check, is this particular amount here, recoverable service amount, is it less than this? So obvious, this one is not less. This one is not less than the carrying amount, is not less than the carrying amount. What does that mean? It means that this particular market here, this particular non-cash generating asset here is not impaired. Is not what? Impaired. Therefore, no impairment loss which is to be recognized. So that will be the answer here. So we say the asset is not impaired, simply because the recoverable service amount is not less than what? The carrying amount. The asset is not impaired, and therefore no impairment loss is to be recognized. No impairment loss is to be what? Is to be recognized. So basically that is it, that's what was required. So let's move to the other illustration, and it reads, on 1st of January 2014, the government acquired a modern software to enhance the service delivery at a cost of 350 billion. The software had estimated useful life for over 8 years, and its benefits would accrue evenly on a straight line basis over the software useful life. As at 31st of December 2018, the usage of the software had dropped to 15% of its originally anticipated demand. A software to replace the remaining service potential of the existing software would cost 150 million. So what are we required? We are required to determine the impairment loss to be recognized for the software using the depreciated replacement cost approach. So here what we are required, remember this was Roman 1 of our illustration. That was Roman 1. Roman 2, we are also required to determine the impairment loss to be recognized, but using which approach? Using the depreciated replacement cost approach. And it is also important for you to recall that the difference between these three methods, what we have done here, restoration cost approach, the depreciated replacement cost approach, and the service unit approach, the difference is purely how we determine the value in use. So how we determine the carrying amount and the net realizable value, the approach is the same. The difference comes in when determining the value in what? In use. So what we just need to remember here is, or we need to have the formula for computing the impairment loss, which you have said is equal to carrying amount, which is the same with the net book value of the asset, minus the recoverable service amount. So we need to determine these two values, and basically we are determining this particular impairment loss on the date when there was some evidence showing that this particular asset could be impaired. And I think there is some information which you are told there, or which you are given, whereby you are told on 31st of December 2018, the usage of this software had dropped by 15%. Had dropped by 15 what? %. So meaning that the performance of this particular software is worse than what was originally expected. So this is one of the factors which indicate that this particular asset could be impaired. And therefore, in accordance with IPSAS 21, the public sector entity should carry out impairment review at the end of 2018. So therefore, we are determining this carrying amount, this particular net book value on that date, on 31st of December 2018. So to compute this is basically quite simple. We take the costs of the software, which we are given in the first paragraph, which is 350 million, and then we less the accumulated depreciation. How do we compute the accumulated depreciation? We take 350 million, divide that with the expected useful life of this asset, which are 8 years, and then on this date, this particular software had been used for how many years? So remember, it was acquired at the start of 2014. So meaning that it was used, the software was used in 2014, 2015, 2016, 2017, 2018. Those are how many years? 1, 2, 3, 4, 5. So we need to compute the accumulated depreciation for 5 years. And basically that will give us what? That will give us the net book value or the carrying amount. So let's compute that. We work out that. We have 350 divided by 8 times 5. We rest that from the cost of 350, and that will give us 131.25 million. So that is the carrying amount or the net book value at the end of 2018. So then from there we proceed, and we already have this, we proceed, we determine the recoverable service amount. Recoverable service amount. That is the abbreviation for that, recoverable service amount. And basically this is the higher of two values. This is the higher of two values. Number one, the net realizable value or fair value less cost to sell. And equally, if you check on the information given in this particular question here, this figure is not given. We are not given the NRV, the net realizable value or the fair value less cost to sell. So that will not apply here. So we take the higher of that, or number two, what refers the value in use. The value in what? In use. Now the value in use, which approach are we using here? The examiner requires to compute this using this particular approach, the depreciated replacement cost approach. So therefore, that is the approach which you're using here, depreciated replacement cost what? Approach. Yes, so let's determine the value in use under that particular approach or method. Value in use. So to determine the value in use, what we do, we take the replacement cost. The replacement cost is basically the cost which will be incurred by the government in constructing a similar market. We are given that information, not a similar market, but in terms of acquiring a similar software. A similar software, we are told acquiring a similar software currently, or a similar software currently goes for 150 million, and we depreciate this, or to this we less accumulated depreciation, which will be equal to the replacement cost, which is 150, and we depreciate this for an equivalent duration as this particular asset. Divide that with 8 times what? Times 5. Times 5. So let's work out that. We see what it will give us. We see what we are going to get here. We have 150 divided by 8 times what? Times 5. Times 5, which will give us 93.75 million. And whatever you get here is now the value in what? In use. So that is how we determine the value in use under this particular approach here, or under this method, which is depreciated replacement costs approach, which is 56.25. So having that, finally, we need to get now the recoverable service amount. Recoverable service amount. The recoverable service amount, you should take now the higher of this value in the value in use and the fair value less cost to sell. In our case, remember, we don't have that, so automatically our value in use will be equal, sorry, our recoverable service amount will be equal to the value in use, 56.25 million. 0.25 what? Million. So having that, then we equally need to determine whether our asset is impaired or not by checking whether the recoverable service amount, whether this amount is less than the carrying amount. Is less than the carrying amount. This was supposed to be less. Is supposed to be less than the carrying amount. So the recoverable service amount is 56.25 M. What about the carrying amount? Is this one, 131.25 million. So in our case, we can say this one, the recoverable service amount is what? Is less than this one. So meaning that we need to proceed and we determine what? The impairment loss. So the impairment loss is determined using this formula. So the impairment loss is equal to carrying amount, which you already have here, 131.25 million minus the recoverable service amount, which we have here, 56.25 million. And we get the difference. We get the difference. Yes, so which will be 75 million, 75 million. So that is basically the impairment loss, or how we determine the impairment loss using that particular what? Using that particular approach, which is known as the depreciated replacement what? Cost. I want us to look on the last illustration. We look on the last illustration. So let's go through the illustration. We see what we are told. So the illustration leads with reference to IPSAS 26, which deals with the impairment of cash generating asset, explaining the following terms. So IPSAS 26 basically is equivalent to IS 36. So the definition of those particular terms under IS 36 is the same with the IPSAS 26. So the first term we are required to define is the value in use. So the value in use, in very simple terms, is the present value of the expected cash flows to be generated from the continued use of the asset and also from its what? Disposal. So what about the recoverable amount? The recoverable amount, this one, is the higher. We say this is the higher of cash generating assets, value in use, or number two, fair value less cost to sell. Less cost to sell. That is how we define those particular terms. And then part B, that is what I want us we compute here, or basically we do. So we are told on 1st January 2008, Mashabani County Education Department purchased a printing machine at a cost of 40 million. The department estimated that the useful life of the machine would be 10 years. And then you are told on 31st of December 2012, it was reported that automated feature of the machine function did not operate as expected, resulting in 25% reduction in the machine annual output over the remaining 5 years of its useful life. The cost of a new printing machine was 45 million as at 31st of December 2012. So what are we required to do? We're required to determine the impairment loss using the service unit approach. So we are required to determine the impairment loss using service unit approach. Using a service unit what? Approach. The first thing always you need to have here is the formula for computing the impairment loss. The impairment loss is equal to a carrying amount of the asset minus the recoverable service amount. Recoverable service amount. So we need to have these two values. Let's start by determining this one, carrying amount. Carrying amount, which is basically the same with the net book what? Value. And equally we are determining this when there was a factor which showed that this asset could be impaired. And there is some information which are given in that question that on 31st of December 2012, it was reported that automated feature of this machine was not operating as expected, resulting in 25% reduction in the machine annual output. It means that the performance of this asset was worse than what was originally expected due to that feature, automated feature of the machine not working as what is expected. Therefore, an impairment review was supposed to be conducted on 31st of December 2012. So how do we determine the carrying amount? We take the cost, which we are given in paragraph 1 as 40 million. 40 million, we less the accumulated depreciation. The accumulated depreciation would be 40 million. Divide this with the expected useful life of this machine, which are 10 years, and then times the number of years the machine had been used before the end of, or basically as at 31st of December 2012. So how many years do we have? Take into account it was acquired in 2008. So we have 2008, 2009, and then we also have 2010, 2011, 2012. So these are 5 years. 1, 2, 3, 4, 5. So we have 5 years. 5 years. So this will give us what? This will give us 20, meaning that the carrying amount or the net book value will be what? Will be 20 million. So having that, we proceed and we determine now the recoverable service amount. The recoverable service amount, which we know by now that this is the higher of two values. Higher of number 1, net realizable value, or the fair value less cost to sell. And in our case, equally, we are not given this. We are not given this. In most of the questions, it is important to note that you not be given that fair value less cost to sell, because it is very rare for the government to be able to sell its asset. To be able to sell its what? Its asset. That's why you can see actually in all questions which you have done, there is nowhere you have been given, or there is no question or no illustration whereby you are given the fair value less cost to sell. So we take the higher of that all. Number 2, the value in use. The value in what? In use. Now, this value in use, we are required to compute that using this approach here. The service unit what? Approach. Service unit what? Approach. So how do we determine the value in using this particular approach? The first thing we need to do is to compute the depreciated replacement cost. So we take now the replacement cost, which is also given in that question in the last sentence, whereby you are given the cost of a new printing machine. If the government wants to acquire a new printing machine currently, such a machine will be bought at 45 million. So what we need to do is we less accumulated depreciation, which is computed by taking the replacement cost, and then we depreciate that amount with an equivalent duration. So we divide this with 10 times what? Times 5, which is basically half of that, 22.5 million. And whatever you get here is known as the depreciated replacement cost, which equal to be 22.5 million. So having this depreciated replacement cost and the service unit approach, we say to get the value in use, we take the depreciated replacement cost, and then we multiply that with the proportion of the remaining service potential. We multiply that with the proportion of the remaining service potential. There is something which you are given in that particular question, whereby we are told, due to that automated feature of the machine not operating as expected, the annual output of this machine in the next 5 years was expected to reduce by 25%. So meaning that the remaining service potential of this particular machine over the next 5 years, we can say is 75%, because the annual output of this machine in the next 5 years is expected now to do what? To reduce by 25%. So therefore, what we have done to compute the value in use, we have taken the depreciated replacement cost, and then we have adjusted that. We have multiplied that with the proportion of the remaining service remaining service units. So we have 22.5 times 75%, which will give us now what? Which will give us 16.875 million. And I think now, having that, finally what we need to do is to determine the recoverable service amount. We determine the recoverable service amount, of which the recoverable service amount automatically will be the higher of these two values here. So remember, in our case, we don't have this. So automatically the recoverable service amount will be equal to value in use. The value in use is this one, which is 22.5 million. 0.5 what? A million. And I think having that, finally, we need to determine whether this asset is impaired or not by comparing the two values, by determining whether the recoverable service amount is less than carrying amount. So our carrying amount, we have it here, 20 million. What about the recoverable service amount? Is 22 point, not 22, sorry, this should be whatever I have determined here. Let's change that. So this, the recoverable service amount is 16.875 million. So our recoverable service amount is 16.875 million. So what we need to do is basically to determine, is this less than that? Yes. So we can see the recoverable service amount is less than the carrying what amount. If that is the case, then finally we need to determine the impairment loss, because this particular asset is impaired. If the recoverable service amount is less than the carrying amount. So the impairment loss will be equal to carrying amount, which is 20 million, minus the recoverable service amount, which is 16.875 million. So what will be the difference here? It is 3.125 million, and that is the impairment what? The impairment loss. So basically that is it, that what was required in those particular three illustrations, whereby the examiner was requiring, as a candidate, you compute the impairment loss of non-cash generating asset in accordance with the IPSAS 2021. So therefore, we have looked on how to compute the impairment loss under the depreciated replacement cost approach, under the restoration cost approach, and also under the service unit approach. And basically that brings us now to the end of that subtopic. So once we meet in our next session, we are going to look on how we determine the impairment loss under IPSAS 26. So for now, we stop at that point. See you in the next session.
Hello and welcome, candidates, to the lesson. The subject is Boardroom Dynamics. Today I'm going to start the revision of the paper that was done on Tuesday, 25th April 2023. Boardroom Dynamics. Time allowed 3 hours. Instructions are as follows. Answer all questions. Marks allocated to each question are shown at the end of the question. Do not write anything on this paper. Do not write anything on the paper. So we're going to take a question at a time. This paper has 5 compulsory questions. The first question is a case study, and in April 2023 sitting, the case study about the Loden Cranes Incorporation. I'll first read the case, then we answer the questions below it, that is A, B, C, and D. First paragraph reads as follows. Loden Cranes Incorporation was founded in a small town in Kenya 20 years ago by a group of 10 engineers. The company specializes in the manufacture of various plastic items, including furniture and packaging containers. The 10 founders of the company became the directors of the company and held all the top leadership positions. After 3 years of operation, they decided to broaden diversity in readiness for listing at the Securities Exchange. Independent directors needed to be added to the pool of directors. The achievement of board dynamics was greatly informed by psychological theories. Paragraph 2. The company was eventually listed at the Securities Exchange in November 2020. The founders were fully aware that the listing would allow them to fund and help sustain LKI's growth potential. The company has been growing its portfolio of products steadily, and currently it has over 100 lines of production domiciled in over 20 outlets spread across the country. Market capitalization of the company at the end of December 2022 was 517 million Kenya shillings. In the recent past, the company has been struggling in upholding good governance principles. The company has been facing integrity challenges. It has fallen back in terms of compliance with various statutory requirements. The company operates in a laissez-faire mode where each department is more or less autonomous. Each employee is aware of the fact that there is no documented decision-making tool, a fact that brings about confusion, thereby affecting overall productivity. Meetings in the organization have been very informal. Despite the informal nature of meetings, many directors are highly skilled and dispense their business effectively. During their last meeting, the directors resolved to schedule capacity building sessions so that they could be trained on good corporate governance and board programs. Required: A. Advise the management of the company on the tools that they may adopt to facilitate effective decision making in the corporation. 10 marks. B. Examine 5 governance theories that could inform the company's board structure. 10 marks. C. Analyze 5 skills that could enable the directors become more effective in handling their tasks. 10 marks. And lastly, discuss the essential attributes of the directors that were added to the pool at the company in order to achieve board diversity. We'll first answer part A. Advise the management of Lord Crane's Incorporation on the tools that they may adopt to facilitate effective decision making in the corporation. Tools to do what? To facilitate effective decision making. Tools to do what? To facilitate decision making. That is part A of this question, the case study. The question is asking candidates to do what? To identify tools to facilitate. Tools to facilitate effective decision making. Advise the management of the company on the tools that they may adopt to facilitate effective decision making in the corporation. In paragraph, the first paragraph, that is the third paragraph we read, that in the recent past, the company has been struggling in upholding good corporate governance. The company has been facing integrity challenges. It has also fallen back in terms of compliance with various statutory requirements. The company operates in a laissez-faire mode, all right, where each department is more or less autonomous. Every employee we read is aware of the fact that there is no documented decision-making tool. You see that? Every employee is aware of the fact. It is a fact that there is no documented decision-making tool. And due to that fact, there is a lot of confusion The question reads, a factor that brings about confusion, thereby affecting overall productivity. So there is no documented decision-making tool. So the candidates are required to advise the management on the tools that they may adopt. The first one could be what we call decision-making frameworks. The company could adopt decision-making frameworks. Decision-making frameworks. What are these decision-making frameworks? Now, candidates implementing structured decision-making frameworks can provide a systematic way or approach to resolving issues and making choices. And there are many decision-making approaches which we covered in our class. Remember, we discussed about the rational decision-making model. A good example is the rational decision-making model. That is one example of a decision-making framework. Rational decision-making model. There are many more, like the incremental decision-making model. Incremental decision-making model. The incremental decision-making model. We have the bounded rationality model. Bounded rationality model. The bounded rationality model is another example of a decision-making framework. The bounded rationality model, the incremental decision-making model, the rational decision-making model, and many more models. So by using such frameworks, the directors can evaluate options, they can consider potential risks, they can arrive at well-informed decisions, and so on. So these are some of the tools that we can discuss under point number 1. Then under point number 2 is what we call SWOT analysis model. The SWOT analysis model, where S stands for strength, W stands for weaknesses, O stands for opportunities, and T stands for threats. All right? This is a model that can assist or help the company assess its internal as well as external factors. The model aids in identifying areas that require improvement, that require understanding marketing trends, and making strategic decisions, providing directors with such information as far as the strength, the weaknesses, the opportunities, and threats of the company is concerned. SWOT analysis is yet another tool that can facilitate effective decision making. 3, decision support system. Decision support system. The DSS. DSS. The company can introduce the DSS software that can provide directors with analytical tools and real-time data for making informed decisions. The DSS candidates can help or assist in forecasting. The DSS can also help in scenario planning. It can help in risk analysis, thereby enhancing the quality of decisions. The DSS software. 4, governance policies. The company can put in place governance policies as well as procedures. Governance policies and procedures. Establishing clear and documented governance policies and procedures can create a framework for decision making. It also ensures transparency, it ensures consistency, it ensures accountability throughout the organization. Coming up with governance policies and procedures. 5. Risk management framework. Another tool is developing a risk management framework. Implementing a risk management framework can enable the identification, can enable the assessment, and also the mitigation of potential risks. And that helps the directors make decisions while considering potential consequences and safeguards that the company may face. Risk management framework. Establishing a risk management framework is another tool to facilitate effective decision making. 6. Task force and committees. Task force and committees. Setting up task force or committees to address specific issues can provide focused attention, can provide focused expertise for complex decisions. And such teams or committees can thoroughly analyze matters and propose recommendations to the board for consideration. That's one tool to facilitate effective decision making. The company may be faced with complex problems, complex situations. When that happens, then establish a task force. Set up a committee to look into the complex matter. Set up a committee to thoroughly analyze matters and propose recommendations to the board for decision making. 6 or 7 regular board meetings is another tool. Regular board meetings, formalizing board meetings with a structured agenda, with the minutes, ensures that all key topics are discussed, decisions are recorded, progress is monitored, and so on. Regular board meetings. These are additional points. Candidates were to give just 5 tools. I've given you 7. There are many more tools like expert consultations, seeking expert opinions, and advice on critical matters can provide valuable insights and help in making well-informed decisions by the board. So these are tools to facilitate effective decision making. Number 1 is establishing decision-making frameworks. Under frameworks, I gave examples like the rational decision making model, the incremental decision-making model, the bounded rationality model. The second tool is SWOT analysis. The third tool, decision-making support system. The fourth tool, governance policies and procedures, establishing governance procedures and policies. Number 5, risk management framework, putting in place a risk management framework, establishing a task force or committees to handle complex matters. I've also identified another tool which I call regular board meetings. Then lastly is the expert consultations. Let me put it down. Expert consultations. Expert consultations. Expert consultations. Any 5 points here could earn you the 10 marks. 10 marks. Any 5 points. Any 5 points. Even in point number 1, if a candidate was to explain the rational decision-making model, would earn a mark. Incremental decision-making model, that would earn you a mark. The bounded rationality model, these are tools that facilitate decision-making. I'm now going to part B. Examine 5 governance theories that could inform the company's board structure. Governance theories. Examine 5 governance theories. 5 governance theories. Examine 5 governance theories. Governance. This was yet another easy part of this question. The first governance theory we know is agency theory. Agency theory. Now, this theory examines the relationship between the principals, who in this context are the shareholders, and the agents, who are the directors or managers. This theory emphasizes the interests of agents with those of the shareholders. It emphasizes aligning the interests of the shareholders with those of the agents. Why? In order to minimize any conflicts, ensure effective decision making in the company. Agency theory. I've said the theory examines the relationship between the principal, the principals, these are shareholders, and the agents, these are the directors or the managers. The theory seeks to align the interests of the principals and the interests of the agents so that there is minimal conflict between the principals' interests and the interests of the agents. That is the first governance theory. The second governance theory is stewardship. Stewardship theory. Now, in contrast to the agency theory, the stewardship theory views directors and managers as stewards who act in the best interest of the company. And according to this theory, directors are more likely to make decisions that promote the long-term organizational success and sustainability growth. Stewardship theory. Number 3 is stakeholders theory. Stakeholders theory. Stakeholder theory. Now, this theory, the stakeholders theory, emphasizes considering the interests of all stakeholders. Stakeholders are people or persons who have an interest in the company, people who have a stake in the company. And this could be the suppliers, the employers, the shareholders, the employees, the customers, the government, any person who is affected by the actions of a company is a stakeholder. The stakeholder theory, therefore, emphasizes the need to take into consideration the interests of all the persons who have an interest in the company, and not just the shareholders. Here, the interests of all the other stakeholders other than the shareholders should be emphasized. And adhering to this stakeholder theory can lead to more socially responsible decisions by the company. Adhering to stakeholder theory also improves the reputation of the organization. Stakeholder theory means or emphasizes the need to take into consideration the interests of all the persons who have a stake in the company. I've mentioned examples of stakeholders: the government, the employees, the suppliers, the customers, and so on. Resource dependency theory number 4. Resource dependency theory. Resource dependency theory is a fourth governance theory. Resource dependency theory suggests that organizations are influenced by external resources such as capital and expertise. And this company can use the Lord and Prince's company can use this theory to do what? To gain access or to diversify its network and build relationships with various stakeholders to gain access to essential resources. Do you understand? The resource, from the word resource dependency theory. Resource dependency theory emphasizes or suggests that organizations are influenced by external factors, by external resources such as capital, expertise, and so on. Resource dependency theory. Number 5, contingency theory. Contingency theory. Contingency theory suggests that there is no one-size-fits-all approach to governance. There is no one-size-fits-all approach to governance. And the most effective governance structure depends on the specific circumstances of the organization. There is no one approach that fits all or that can be applied in all the situations. You understand? Contingency theory. There is no one-size-fits-all approach to governance. And that the most effective governance structure depends on what? On specific circumstances of the organization. And therefore, this company, for example, the Lord's Princes Incorporation, can tailor its governance practices to suit the company's unique characteristics and challenges, because this company is unique. And therefore, the company should develop or come up with an approach that is unique to its challenges, that can address governance problems. So these are 5 governance theories that could inform LKIS board structure. 1, agency theory. 2, stewardship theory. 3, stakeholders theory. 4, resource dependency theory. Then 5, contingency theory. C, analyze 5 skills that could enable LKI directors become more effective in handling their tasks. Skills. The question is testing candidates' knowledge on skills that could enable directors become more effective. Skills that could enable directors become more effective. Skills that could enable directors become more effective. One important such skill is developing what we call strategic vision. Strategic vision. Strategic vision. Directors need to have a clear strategic vision for the company's future and then align their decisions with the long-term goals. And that involves understanding market trends, that involves understanding competition, that involves understanding potential opportunities. A skill to understand the market trends, you require to have a skill to understand the potential opportunities and so on. So directors should have strategic vision, the long-term vision. They should have clear strategic vision for the company's future. That will enable them to become more effective. Financial acumen. Financial acumen is another skill. The directors should have strong financial literacy. A strong financial literacy, candidates, is essential for directors to analyze financial statements, to analyze budgets and investment decisions effectively. Directors may be called upon to make decisions related to investment. Directors may be called upon by the very nature of their job to analyze financial statements that are prepared by the accountants of the company. And to analyze financial statements, one needs to have financial acumen. One needs to have literacy, a strong financial literacy. And that's a very important skill that could enable directors become more effective. Communication and interpersonal skills, number 3. Communication is a skill that directors need to possess. Effective directors should be able to communicate their ideas. They should be able to communicate their concerns. They should be able to communicate their decisions clearly to the entire organization. We will mention here, directors should have a strategic vision. This vision that the directors should have about the organization ought to also be communicated to the other members of the company, to other stakeholders. And therefore, the directors should have communication skills. They should be able to communicate clearly. They must foster a healthy relationship with the shareholders, with the management, and other stakeholders. And that can only happen if they have communication skills. They should be able to communicate their ideas, their concerns, their decisions clearly to the entire organization, to the stakeholders, and so on. Communication and interpersonal skills. Problem-solving skills, or what we call analytical skills, is another skill that could enable directors become more effective. Number 4, analytical skills. Problem solving or analytical skills. Problem solving skills or analytical skills. Problem solving. Directors should be skilled in analyzing complex situations, analyzing complex issues. The directors should have skills in identifying challenges. The directors must have skills in proposing effective solutions to the challenges that they have identified. So it's not enough to just identify challenges. It's also important the directors also have skills to propose effective solutions to the challenges that are faced by the organization. 5, ethical decision making. Ethical decision making, from the word ethics. The director should be able to uphold ethical standards. Why? Because upholding ethical standards is essential for directors, especially in addressing integrity challenges faced by the company. So ethical decision making ensures that the company operates with integrity and also maintains a positive reputation. Because we all know by now that a positive reputation is an asset to any organization, is an asset to any person. One who holds ethical or one who is has high standards of integrity. A company that upholds ethical standards is a company that is likely to maintain a positive reputation, and is a skill that directors must learn. Ethical decision making. So these are 5 skills that could enable the directors of this company become more effective. Strategic vision, number 1. Number 2, financial acumen. Number 3, communication and interpersonal skills. Number 4, problem solving or analytical abilities. Then number 5, ethical decision making. Ethical decision making. So that is part C of that question. Part D, discuss the essential attributes of the director that were added to the pool at LKI in order to achieve board diversity. All right. We read in the question that meetings in the organization have been very informal. During their last meeting, the directors resolved to schedule capacity building sessions so that they could be trained on governance, good corporate governance, and board programs. So the question here is, discuss the essential attributes of the directors. D. Essential attributes of directors that were added. So there are directors that were added to this board. because we read that the 10 founders of the company became the directors of the company and held all the top leadership positions. After 3 years of operation, they decided to broaden board diversity in readiness for listing at the Securities Exchange. They decided to do what? To broaden the board diversity in readiness for listing at the Securities Exchange. The achievement of board directors was greatly informed by psychological theories. The question is, what are the essential attributes of the directors that were added to the pool? The first attribute is diversity in backgrounds. Diversity in background. One, background diversity. When new directors were recruited, one important attribute to look at, or that was looked at, was the diversity in their backgrounds. The new directors should come from various professional backgrounds, from various industries and experiences, because this diversity brings different perspectives, brings different expertise to the board, and thereby promoting innovative thinking. Innovative thinking. Two, inclusive mindset. Inclusive mindset. Directors with an inclusive mindset actively seek to understand and also to appreciate diverse viewpoints. Such directors should value contributions from all board members, regardless of their backgrounds. So directors that were included should be ones that have what we call an inclusive mindset. This is a mindset that tolerates diverse opinions. Do you understand? 3, industry knowledge. Industry knowledge. Adding directors with relevant industry knowledge and expertise can help this company to navigate challenges specific to their sector and also stay competitive. 4, another essential attribute is that of independence. 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 Directors of a company should have independent mind. Independent mind. Why? Because independent directors are crucial for maintaining impartiality and avoiding conflicts of interest. They should not only have affiliations, but also financial interests or ties to the company. So when recruiting the new directors, an essential attribute that should be considered, or that was considered, is that of independence. The directors ought to be independent. 5, governance experience. Governance experience. Directors with prior governance experience bring valuable insights into the company. They bring into the company what we call best practices and can help the company improve its governance standards. And therefore, candidates, by embracing these diverse attributes, the company can benefit from robust discussions. The board can benefit or can make better decisions, and also enhanced governance practices. So these are some of the essential attributes that were added, that were considered when adding new directors to the company. Number one, background diversity. Number two, inclusive mindset. Number three, industry knowledge. Number four, independence. Number five, governance experience. How many marks? This should earn 10 marks. 10 marks. So these are 10 marks. Part C, 10 marks. Part B, 10 marks, giving us a total of 40 marks. So this is the case study that was tested in April 2023. The subject is Boardroom Dynamics. The course is Certified Secretaries. Thank you for attending this lesson. In our next lesson, we're going to answer question number 2 from the same sitting. Bye-bye.
Hi candidate, welcome to another session of manifested online classes. So in this particular session, I want us to look on an illustration question on analysis of financial statement. And the question I want us we go through is the question which was tested in the sitting of August of 2022, specifically question number 5B. So the question reads, Dragon Limited is a public entity which has grown in recent years by acquiring established business entities. The directors of Dragon Limited have identified 2 potential entities targeted for a takeover. The directors believe that shareholders of the 2 target company would be recipient to a takeover. As a prerequisite to the takeover decision, the directors have tasked a firm of consultants to carry out cross-sectional analysis of the financial statement of the potential target companies which operate in the same industry sector. The financial statements of 2 entities as at 30th April 2022 are shown below. We have the statement of profit or loss for the year which ended 30th of April 2022 for 2 companies, Able Limited and Cedar Limited. We have revenue, cost of sales, gross profit, distribution cost, admin expenses, operating profit, finance cost, profit before tax, income tax expense, and then we have the profit for the year. We also have the statement of financial position as at 30th of April 2022 for Able and Cedar Limited. We have the non-current asset which include property, owned plant, right of use asset. At the current asset we have inventory, trade receivables, bank total assets, and then we have equity which comprises of ordinary share capital, evaluation reserve, retained earnings, and then we have the total equity. At the non-current liabilities we have the lease liability, 10% loan notes, and then we have current liabilities which comprises of trade payables, lease liability, current tax, and then we have the total equity and liabilities. What is required in Roman 1 of that question is common size statement of profit or loss for the 2 entities for the year which ended 30th April 2022. Roman 2 common size statement of financial position as at 30th April 2022. And finally, we are required to advise the directors of Dragon Limited on the best company for the takeover. So let's start with the Roman 1 of that particular question, whereby the examiner was requiring we prepare common size statement of profit or loss, statement of profit or loss for the 2 entities, which is for the year which ended 30th of April 2022. Remember, when talk about the common size, a statement of profit or loss, this is prepared by expressing all items in the income statement or the statement of profit or loss as a percentage of total asset. So not the total asset, but rather the revenue or the total revenue. We are going to express all items as a percentage of the revenue. And take into account we have two companies. We have two companies. We also need to have two columns here. The first column will be for the company which is called Able Limited, and the other one will be for the company which is called Cedar. So what we do, we express all those items in the income statement as a percentage of revenue. So revenue as a percentage of itself is always 100%. This one is 100% because what we do, we take the revenue, for example, for Able, 87,500, then the denominator here will be the revenue. So 87,500 times what? Times 100, times 100. So that is always 100%. Then we have the cost of sales. So to express the cost of sales as a percentage of revenue, we take the cost of sales 66,500, divided that with the revenue for that company which is Able, 87,500 times 100. That is for the first company. For the other company which is Cedar, we are going to do the same. Take its cost of sales, 114,800, divide that with the revenue for Cedar Limited times what? Times 100, times 100. So let's compute this. We see what we are going to get here. We see what we are going to have. So we have 66,500 divided by 87,500 times 100. That will give us 76%. 76%. What about the other company? Okay, so I think first of all we can deal with the Able, whereby we are going to express all items in the income statement of Able Limited as a percentage of what? Of revenue. So let's go to the gross profit. Gross profit. So the gross profit in this case is 21,000 divided by revenue 87,500 times 100. This will give us 24%. What about the other item, which is the distribution cost? Distribution costs. So the distribution cost is a figure of what? Is a figure of 1495 divided by 87,500 times 100%. That will give us 1.78%. Then we have the administrative expenses. The administrative expenses, which is 2880 divided by revenue 87,500 times 100, which will give us 3.29%. Then we have the operating profit. Operating profit. And I hope you can see what I'm doing here. We are expressing everything as a percentage of revenue. You don't have to underline anything. You don't have to put anything. You don't have to show anything as a negative. You just show, you express all those items as a percentage of revenue, as a percentage of the company's revenue. So we have the operating profit, which would be 1625 divided by 87,500 times 100. So that will give us 19%. Then below that we have the finance cost. Finance cost. The finance cost in our case is 875 divided by 87,500 times 100, which will give us 1%. This is 1%. Then below that we have the profit before tax, which is a figure of 15,750 divided by 87,500 times 100%. Times 100%, which will give us, okay, let's take that again. We have what? We have 15,750 divided by 87,500 times 100, which will give us 18%. Then we have the income tax. So for the income tax is 3150 divided by 87,500 times 100, which will give us 3.6. And finally, we have the profit for the year. The profit for the year, 12,600 divided by 87,500 times 100. That will give us 14.4%. 0.4%. So we need to repeat the same process for the other company, that is Cedar. We express everything as a percentage of the revenue for Cedar. So we go to the cost of sales here, which is 114,800 divided that with revenue, which is 140 times 100. That will give us 82%. 82%. What about the gross profit? 25,200 divided by 140 times 100. This will give us 18%. Then we have the distribution, which is 2710 divided by 140 times 100, so which will give us 1.9%. Then below that we have the administrative expenses, 5340 divided by 140,000 times 100, which will give us 3.81%. Then from there we have the profit, the operating profit, 17,150 divided by 140,000 times 100, 12.25%. And then below that we have the finance costs, 3,150 divided by 140,000 times 100, which will give us 2.25%. Then we have the profit before tax, 14,000 divided by 140,000 times 100. Times 100, which will give us 10%. Then we have the income tax, 3,500 divided by 140,000 times 100, which will give us 2.5%. And finally, we have the profit for the year, 10,500 divided by 140,000, which is 7.5. So that is what we refer as the common size statement of profit or loss. It is also important to note that from this common size statement of profit or loss, there are a number of ratios which you have already computed here, and which you can use in terms of evaluating which company is performing better than the other. So the first ratio which you have computed is what we have here, this one. Because in computing this, what we have done, we have taken the gross profit all over revenue times 100, and therefore this is a gross profit margin. A gross profit margin. So you can use that to compare the profitability of two companies, and going with the gross profit margin, we can say this company is profitable than Able is profitable than Cedar. We also have this other ratio here, which we have computed by taking the operating profit or the profit before interest and tax all over revenue times 100. So this is what we refer as operating profit margin. So equally, you can see, going with that ratio, profitability ratio, we can see this company is more profitable than Cedar. And also we have this other profit, this other ratio here, where we have taken profit after tax all over revenue times 100. So this is what we refer as a net profit margin. And equally, going with that, we can also see that this company here, that is Able, is more profitable than what? Cedar. In fact, we can make that particular conclusion here, that Able Limited is more profitable than what? Than Cedar. Limited. Remember, this particular information will help us in terms of advising the management of this company, which is Dragon Limited, on which company to acquire. Remember, we are told that Dragon Limited is targeting to acquire either Able or Cedar. So if in this case we are advising the management based on or we are advising the management on which company to acquire based on their profitability, automatically we are going to advise them to acquire which company, this company that is Able, because you can see as per these three profitability ratios, this company is more profitable than what? Than Cedar. So let's move to Roman 2 of that particular question. And Roman 2, what the examiner was requiring is the common size statement of financial position. Common size statement of financial position. And this one is basically prepared by expressing all items in the statement of financial position as a percentage of the total asset. Equally, you have to remember that the common size, this is all known as the vertical analysis. The vertical analysis statement of financial position. Statement of financial position. So here what we need to do is to express all items here as a percentage of total asset. We equally need to have two columns. We have Able Limited, and then we have Cedar Limited. We are going to express all items as a percentage of total asset, as a percentage of total assets. So we start with the non-current assets. We have property. Then we have owned property or owned plant. We have right of use asset. Right of use assets. And then we have the current assets. So for the current asset, we have inventory. We have trade receivables. Then we have bank. And then total assets. Total assets. So basically, total asset, because we have to express everything here as a percentage of total asset. Once we express total asset as a percentage of itself, that automatically give us 100 what? 100%. 100%. 100%. So we're going to compute all these particular items as a percentage of total asset. And then below that we have equity. Equity, we have ordinary share capital. We have retained. Okay, before that we have revaluation surplus. Revaluation surplus. We have retained earnings. Retained earnings, and then we have the total equity. Okay, so we can just ignore that. And then we have non-current liabilities, where we have the lease liability. And then we have 10% loan notes, 10% loan notes. And then from there we have current liabilities. We have current liabilities. For current liabilities, we have three. We have trade payables. We have lease liability. And then finally we have current tax. And then we have the total equity and liabilities. Total equity and liabilities. And equally here, total equity and liabilities, this is the same with the total asset, and therefore once we express this as a percentage of total asset, automatically it will give us what? It will give us 100%. So therefore what we need to do, we need to express all these items in the statement of financial position as a percentage of total asset. So let's start with the property, and we start by doing that for the first company, which is Able. So we have 9,800. 9,800 divided that with the total asset. Total asset as given as that is 3,600 times 100. which will give us 29.2%. And then for the other company here, okay, for the other item we have 7,000 divided by 33,600, which will give us 20.8. This company was not having any right of use asset. What about current asset? We start with the inventory, 5,600 divided by 33,600, which will give us 16.7%. Receivables, we have 7350 divided by 33,600, which will give us 21.9%. And then we have the last item, which is not the last item, but the other item, which is 3850 divided by 33,600, which is 11.5. 11.5. So we need to do the same to the other items of equity and liabilities. Let's start with the ordinary share capital, 3,500 divided by 33,600, which will give us 10.4%. 0.4%, and then we have 1750, which is the revaluation surplus divided by 33,600, which will give us 5.2. Remember, here we are expressing everything as a percentage of total asset. What about the retained earnings? 5,600 divided by 33,600, which will give us 16.7%. What about the risk liability? This company was not having a risk liability. The company only had the 10% loan notes, which is 15,750 divided by 33,600, which will give us 46.9. Then from there we have current liabilities. So we have trade payables 4375 divided by 33,600, which will give us 13.0%. No risk liability. And finally we have tax 2625 divided by 33,600, which will give us 7.8%. So basically what we have done here, we have expressed all items as a percentage of total asset. We need to repeat the same exercise, the same process for the other company, which is CEDA. We compute everything as a percentage of total asset. Let's start with the property, which is 10,500 divided that with the total asset 66,500. This will give us 15.9%. The owned plant 8050 divided by 66,500, which is 12.1%. And then we have the right of use asset 17,500 divided by 66,500, which is 26.3%. We go to current asset. We start with the inventory 11,900 divided by 66,500, which will give us 17.9. Then from there we have 17, the other item of receivable 17,850 divided by 66,500, which is 26.8%. Then we have the last item, which is bank 700 divided by 66,500, which is 1.1%. 1.1. Okay, so we go to the items of equity. We have 7,000 divided by 66,500, which will give us 10.5%. Then we have revaluation surplus 150 divided by 66,500, which will give us 4.7. percent. Retained earnings, we have 9450 divided by 66,500, which will give us 14.2%. 0.2%. What about the lease liability? 14,700 divided by 66,500, which is 22.1%. And then the 10% loan notes, 17,500 divided by 66,500, which will give us 26.3%. We go to the current liabilities. We have trade payables, 7350 divided by 66,500, which will give us 11.1. 11.1. We have 2450 divided by 66,500, which will give us 3.7%. And then finally we have tax, 49 divided by 66,500, which will give us 7.4%. 0.4%, yes. So basically that is it, that what was required there. We have been able to express all items as a percentage of what? The total asset, as a percentage of total asset. And basically by doing all this, expressing these items as a percentage of total assets, basically by doing that you get how many marks? You get 5 marks. 5 marks. Marks. And equally for the first Roman 1 of this question, equally the marks which were located here were 5 marks. Were 5 what? 5 marks. And then from there we need to answer the last part of that question. The last part of that question. So we are told to advise the directors of Dragon Limited on the best company to acquire. Advice on best company to acquire. So between these two companies, that is Able and Cedar, which company should be acquired? Which company should be acquired? So for you to be able to, or for us to be able to give this particular advice, we base it on 2 aspects. One is the financial performance. And I think from the analysis which we did here, we said that the first company here, that is Able, this company is performing well based on these 3 ratios which we identified there. So based on the performance, the best company to acquire is what? Cedar. Number 2, you also have now to look on the financial stability of the company. So when checking on the financial stability of the company, you look on the extent to which the company is financed by the debt capital or by the borrowed capital. So therefore what you do, you come here and you check which company is financed by huge amount of debt capital. And basically in this case, when talk about the debt capital, I think we are talking of, I think just one here. This is the main form of debt capital, the 10% loan notes. Here we can be able to see that this company is 46.9 and this company is 26 point what? 0.3. Point what? 0.3. So therefore in this case equally we can be able to recommend that this company or the directors of Dragon to acquire which company? To acquire Able. So therefore we can say advice on the best company to acquire, we can say I will advise directors of Dragon Limited to acquire as Able Limited, since it is more profitable, it is more profitable than Cedar Limited. It is more profitable than what? Cedar Limited. Basically by giving that particular advice, you get how many marks? You get 2 marks. You get 2 marks. Yes. So basically that is it, that what was required as far as that particular question is concerned. And that is the only question which has been tested in this particular past papers for FRA. regarding what we refer as the common size analysis. Equally, that brings us now to the end of that particular topic, and the topic was analysis of financial statement.
Greetings to you all and welcome to the lesson. We are going to begin revising the meetings, compliance and administration past paper that was done on Wednesday, 3rd August 2022. We'll first answer question number 1. Part A reads, explain the term public place in regard to public order legislation. Explain the term public place in regard to public order legislation. Explain the term public place in regard to public order legislation, 2 marks. Now, candidates, in the context of public order legislation, the term public place refers to any location that is accessible to the general public regardless of ownership or control. So it is any location that is accessible to the general public. A public place is a place or location. It refers to any location that is accessible to the general public, regardless of ownership or control. And it typically includes areas such as streets, parks, sidewalks, public buildings, and any other spaces where individuals have reasonable expectation of access and use. And such places are subject to regulations and restrictions aimed at maintaining order, aimed at maintaining safety and public welfare. So that is a public place. It's not like in my compound where the general public have no reasonable access. Private homes are not public places because such places are not accessible to the general public. But places such as streets, parks, public buildings, in such places, individuals expect to have access. They expect to have use. Individuals expect to have use on sidewalks, on public roads. So public places, as I've said again, are subject to regulations. Such places are subject to restrictions that are aimed at maintaining order, because you cannot do anything you want on a sidewalk because it is a public place. You may be accused of obstruction. So there are certain restrictions to safeguard this, to bring about safety and public order. So a public place is a location that is accessible to the general public. That is the answer. 2 marks. Part B reads, describe the 3 contents of a notice for a public meeting used by a regulating officer or the police. Contents of a notice for public meeting. Contents of a notice. Contents of a notice for a public meeting issued by a regulating officer or the police. The contents we're talking about here, the question is referring to contents of a notice. Now, this one seems to be an easy question because candidates should expect a notice to have a date. If it is a notice for a meeting, then we expect a notice to have the time the meeting will be held. You may also expect a notice for a meeting to have a venue. So the notice should clearly state the date, the time, and specific venue where the public meeting will take place, because that ensures that participants have the necessary information to attend the meeting. Date, time, venue. That is one content. Date, time, venue. Date, time, venue. Number one, date, time, venue. These are three contents in one. Date, time, venue. Three contents in number one. Then there ought to be the purpose and agenda. Purpose of the meeting and the agenda. The purpose of the meeting and the agenda. The notice should outline the purpose of the meeting and provide an agenda listing the topics or issues to be discussed, because that helps attendees understand the focus of the meeting. It also helps the attendees to prepare accordingly. Purpose and agenda. 3, rules and regulations. Rules and regulations is yet another content of a notice for public meeting. Rules and regulations. The notice may include any rules or guidelines or regulations related to behavior, right? That is related to behavior on how the attendees are expected to carry out themselves. So the notice, I'm saying, may include any rules, may include any guidelines or regulations, or sometimes restrictions that attendees must follow during the meeting, and that includes regulations related to the behavior, the use of amplification equipment, or any other specific requirement to maintain order and safety during the meeting. So these are 3 contents of a notice for public meeting. Date, time, venue, purpose and agenda, rules and regulations. These are 3 marks. Part B. Then part C, discuss 5 reasons why organizations might prefer to employ an in-house corporate secretary and not outsource. Reasons why organizations might prefer to employ an in-house corporate secretary and not to outsource. Now, candidates, there are several reasons why an organization might prefer to employ an in-house corporate secretary instead of outsourcing that role. One reason is company-specific knowledge. Company-specific knowledge. Company-specific knowledge. What does that mean? An in-house corporate secretary develops an in-depth understanding of the organization's operations, culture, and even the governance structure. And such knowledge allows them to provide tailored support and guidance to the company, to the management, and also the board of directors, as opposed to outsourcing. When you outsource a corporate secretary, such outsourced corporate secretary may not understand the company-specific knowledge, may not understand the culture of the company, may not understand the operations of the company. But if you have an in-house corporate secretary, such an in-house corporate secretary will over time develop knowledge, and also understanding of the organization's operations, culture, and even the governance structure. So that is one reason why organizations might prefer to employ an in-house corporate secretary as opposed to outsourcing one. Number two, accessibility and availability. Having an in-house corporate secretary ensures ready access to the expertise and support. They are readily available for day-to-day operations. They are ready for day-to-day interactions, board meetings, and other important events, providing timely advice and assistance. An in-house corporate secretary is always available and accessible. That is an advantage. Confidentiality and trust. Confidentiality and trust. An in-house corporate secretary becomes familiar with sensitive company information such as legal matters, board discussions, and strategic plans. So building a long-term relationship of trust and confidentiality is crucial for maintaining the integrity and the privacy of confidential information. The integrity and also privacy of such confidential information. For alignment with company culture. Alignment with what? With the company culture. Now, candidates, an in-house corporate secretary can align their work practices and communication style with the organization's culture. They become more attuned to the company's values, goals, and even expectations, thereby facilitating effective collaboration and understanding among the stakeholders. Alignment with company culture. 5. Proactive risk management. Proactive risk management. An in-house corporate secretary can actively identify and mitigate governance and compliance risks within the organization because they can monitor regulatory changes, they can implement best practices, they can ensure proper documentation and also reporting, thereby reducing the organization's exposure to potential for legal or reputational matters or issues. So a in-house corporate secretary can be proactive when it comes to risk management. So these are 5 reasons why organizations might prefer to employ an in-house corporate secretary as opposed to outsourcing one. One is company-specific knowledge. Number 2, accessibility and availability. Number 3, confidentiality and trust. Number 4, alignment with company culture. Then lastly, proactive risk management. So these are 5 reasons. 10 marks. 5 reasons, 10 marks. The last part of this question reads, analyze 5 characteristics of a good resolution in a meeting. 5 characteristics. Characteristics of a good resolution in a meeting. A good resolution must be clear. Number 1, clarity. Clarity. A good resolution should be clear and unambiguous, leaving no room for misinterpretation. It should clearly state the decision or action to be taken by the organization. Clarity. A good resolution is one that is clear, leaving no room for misinterpretation. 2, specificity. Specificity, from the word specific. The resolution should be specific and focused, addressing a precise issue or matter at hand. It should provide sufficient details to guide implementation of the decision. Specificity. Alignment with objectives. Alignment with objectives. A good resolution is the one that can be aligned with the organization's objectives, strategic direction, and legal requirements. It should support the overall mission and vision of the organization. Alignment with objectives. 4, feasibility. Feasibility. A good resolution should be practical and achievable within the organization's resources and capabilities. It should take into account any limitations or constraints that may impact its implementation. Feasibility. Is it a practical resolution? Is it a resolution that is achievable? So a good resolution is one that is practical, one that is achievable, one that is feasible. 5, consensus. Consensus or majority support. Consensus or majority support. Consensus or majority support. Resolutions candidates are typically passed through consensus or majority vote. So a good resolution reflects the collective decision or will of the participants, ensuring that it has broad support among the members or stakeholders who are involved. So these are characteristics of a good resolution. And all in all, candidates, a good resolution collectively captures the decisions made during the meeting and also provides clear guidance for action and promotes alignment and unity among the organization stakeholders. So these are 5 characteristics. It must be clear, specific, aligned with objectives, practical, majority support. These are 5 points, 5 marks. So we've answered question 1 from the August 2022 sitting. The meeting, the subject is meeting, compliance, and administration. Thank you for attending the lesson. In our next session, we are going to answer the second question. Bye-bye. Hello and welcome back to the lesson. We are going to answer question 2, meetings, compliance, and administration, August 2022. Part A reads, discuss 5 roles of a corporate secretary in a shareholders meeting. 5 roles of a corporate secretary in a shareholders meeting. 5 roles of a corporate secretary in a shareholders meeting. Now we are going to discuss 5 roles of the corporate secretary in a shareholders meeting. The first one is meeting logistics. He is responsible for organizing the logistics. Number 2, agenda preparation. Number 3, documentation and communication. The 4th role is meeting facilitation. And lastly, minutes and record keeping. Those are 5 roles of a corporate secretary in a shareholders meeting. Number 1, meeting logistics. Meeting logistics. The corporate secretary is responsible for organizing the logistics of the shareholders meeting, and that includes arranging the venue. It may include ensuring proper notice is given to the shareholders, coordination with the relevant parties for the smooth conduct of the meeting, and so on. The corporate secretary is in charge of the logistics around the meeting. Agenda preparation, number 2.